Hello and welcome to the Chapter 12 lecture. In this chapter, we are going to look at partnerships in detail. So in this particular video, we're going to cover the definition of partnerships, characteristics, the entries for forming a partnership, as well as the allocation of income and losses and the recording of that allocation of income and losses. So we spend a lot of time in Accounting 1 dealing with sole proprietorships, those businesses that only have one owner. With a partnership, it is a voluntary association of two or more people who come together and say, hey, I want to be in business together. These are some specific characteristics of partnerships. So I mentioned the term voluntary association. What that means is that both parties of their own free will and volition decided that they wanted to be in business together. So it's not an issue of someone coming up to you and holding up a gun to your head and saying, hey, you have to be in business with me. No, both parties or all parties mutually agree that we are going to be in business together. For a partnership, the agreement can be in writing or it can be verbal. A verbal agreement will hold up in court, so it does not have to be in writing. If a partnership agreement is in writing, that is known as the Articles of Co-Partnership. If you're smart, you'll make sure you have that agreement in writing so everyone is clear on how income and losses are divided, how the partnership's debt are divided. Who will be responsible for what? There may be some partners that are silent partners in that they only contribute money, but they don't have a lot of say in the day-to-day operations. All of that information is hammered out in that partnership agreement. Very similar to a sole proprietorship, a partnership does have a limited life. That means when one partner dies or when one partner leaves, then that partnership ends. Yes, the business can continue, but it's organized under a different form. If it's only one partner remaining, then it's reorganized as a sole proprietorship. Or if there are multiple partners or a new partner comes in to replace the old partner, then we're dealing with a new partnership. So for example, if it's partnership A, B, and C decides to leave, A and B can continue. They just have to close the books as of the day of C's departure and then reorganize that partnership as partnership A and B. A partnership has what's known as unlimited liability, which means there is no protection for the partners in terms of the partnership's debts. We saw this with a sole proprietorship. And let me give you an example. Let's say that I have a lemonade stand with me and my partner. My partner doesn't make any lemonade. They sort of just take care of the business side of things. But I make the lemonade. And I'm not very good at making lemonade, so I leave a bunch of seeds in there. An opera singer comes and purchases the lemonade. She drinks it, chokes on the seed, damages her vocal cords, and she's no longer able to sing. She's no longer able to make any money. She sues our partnership. In order to satisfy her claim, the business does not have enough assets to satisfy that claim because, of course, she wins because I was found to be liable. Not only can that opera singer and the courts go after the assets of the business, but they can go after my own personal assets as well as the personal assets of my partner. That's what unlimited liability is. There's no protection. And I'm going to be honest with you, the partnership form of business is probably the worst one that you can enter into, almost as bad as a sole proprietorship. In reality, if you're going to start a business, you really want to be an LLC because you want to have those protections in place. One of the positives about a partnership is that it is not taxed. Its owners are taxed. So the income passes through the partnership onto the owners, and each owner gets his or her own separate share. So a partnership is not taxed, but it does have unlimited liability. All of the partners own the assets of the business together, so there is co-ownership of property, very similar to a marriage. The partnership, I say all the time, it's very similar to a marriage, but definitely not the best form of business. And there's one other key concept as it relates to a partnership, and that is mutual agency. Mutual agency says that one partner can bind the partnership in agreement on behalf of the other partner, even if the other partner doesn't know, as long as it's within the normal course of that partnership's business. So within a partnership, again, let's say I have a partnership, and this time we are a law firm, and I go out and get all these new clients as a result of all of my work, and those new clients come in. My partner has to service those new clients because that's what I'm in the business of doing, servicing clients as a law firm. Now, if as a law firm, I, as a partner, decided that now I want to sell meat, and that's not in our partnership agreement, and I go to Hustle Man down the street who sells all this meat from his car, and I buy all this meat, and I say, hey, now we can sell meat too. Well, the company is not liable for those acts because mutual agency only happens when the partner acts within the normal course of the business's operations. So there are multiple types of companies that have partnership-like characteristics. And some of them have similar names because they really are partnerships, and some of them are not partnerships. The first one is the limited partnership. Now remember, a partnership is a voluntary association of two or more people who come together and decide to start a business together. But a limited partnership has partners that are designated as general partners, and they participate in the day-to-day operations of the company, and they have unlimited liability. And they have limited partners who have no liability beyond their personal investments, no personal liability, I should say, beyond their individual investments. So they're not involved in the day-to-day operations, and a lot of times they're more like a silent party. The only thing they can stand to lose is their investment. With a limited liability partnership, or an LLP, you see this a lot with doctors' offices and accounting firms, law firms. And what happens here is that innocent partners are protected from malpractice or negligence claims for other partners. So if you're innocent, then you're not liable for if one partner acts in a way that is malpractice or acts in a way that is negligent. But still, you're still on the hook for partnership debts. And not just on the hook, you're personally liable. So your own personal assets, house, car, all those things can be taken. That's why this is not the best form of business. But it does have positive characteristics, like you're not taxed. So most states have come up with another form of business that offers the benefits of a partnership, but limits the drawbacks. And that would be an LLC or an S corporation. With an LLC, owners are referred to as members. They enjoy limited liability. So very similar to a corporation. They can only lose their investment. They can't lose any of their personal assets. A limited liability corporation typically has a limited life, 70, 75 years. It varies from state to state. But they enjoy not being taxed. So the taxes or the income of the business is passed on to the members, and then the members will pay taxes on that income. S corporation is very similar to a limited liability company. Limited liability is fairly new in terms of an S corporation. S corporation has been around longer than an LLC, but an S corporation limits the amount of owners. So you're looking at 100 or fewer shareholders or owners. And it is treated just like a partnership for tax purposes. So the income gets passed on to the owners, and they are taxed on it, and they enjoy limited liability. So which one should you choose? Should you choose a limited partnership or an LLC or a C Corp? Well, it depends on what your ultimate goals are. I typically advise people, if you're going to start a business, whether you're going to start one by yourself, because you can have a single owner LLC, or if you're going to start with somebody else, do an LLC so that your personal assets are protected. Don't expose yourself. Now that we have that solid foundation for what a partnership is and all of the characteristics of a partnership, let's take a look at some journal entries. It's been a while since we've done some journal entries. Let's look at some. So the same way a sole proprietorship is started, that's the same way we start a partnership. The owners bring asset into the business, whether they invest cash or office equipment. They can even bring liabilities into the business. Those assets and liabilities are recorded at their fair market value on the date the partnership is started. Any assets brought in will increase each partner's capital account, and any withdrawals taken out of the business will decrease a partner's capital account. Here is the primary difference in terms of journal entries for a partnership versus a sole proprietorship. You have multiple capital accounts. So each partner gets their own capital account, and we have to keep track of their withdrawals and their contributions separately. We even have to allocate income to each partner based on the original partnership agreement. Of course, if the partnership agreement is silent, then the income is split evenly among all of the partners. And when I say silent, I mean the partnership agreement says nothing about how income should be allocated. So let's look at this example. We have Kayla Zane and Hector Perez organizing a partnership. Zane's initial investment is $7,000 cash, $33,000 in boarding facilities, and a note payable for $10,000 on the boarding facilities. We see Perez is only bringing in an initial investment of $10,000 cash. We can do this as one big journal entry, or we can do this as two separate journal entries. But here is the key thing. Notice that Kay Zane gets her own capital account, and Hector Perez gets his own capital account. We still debit cash, we still debit boarding facilities, and we credit notes payable for the amount of the liability. We take the difference between the assets and the liability here to find the balance of Kay Zane's capital account. But for Perez, he only brought in cash, so we debit cash and credit his capital account. So this is the same stuff you saw in accounting one when the owner brings money or assets into the business. Now we can have two capital accounts or three capital accounts. The same way we have to keep track of each partner's contributions, we have to keep track of each partner's withdrawals. So we have separate withdrawals accounts now. When it comes to allocating income, remember in the closing process, there are 4 entries that we have to do. In the first one, we close revenues to income summary. Then we close expenses to income summary. And then we close income summary to capital accounts. Well, all of this is true for the partners only when we get to for a partnership, I should say, but only when we get to step 3, we have to close income to each partner's capital account. So we have to allocate or determine how much of net income each partner will receive in terms of our closing entries. And also in the 4th closing entry, we have to close each partner's withdrawals account to the partner's capital accounts. So a little more work here. So since I've been mentioning allocating income and talking about what we do in that 3rd closing entry, let's look at the different ways or different methods we could use to determine how much income a partner will receive. Here is a key takeaway, something that I want you to remember. It's a test question, it's a quiz question. You just need to know it. You'll see it again. You cannot be an employee of a business that you own when that business is a sole proprietorship or a partnership. In a corporation, yes, that can happen. But in a sole proprietorship and a partnership, you cannot be an employee of a business that you own. Why am I telling you this? Well, sometimes in that partnership agreement, we allow partners to receive salaries. Those salaries are not shown as expenses on the income statement like we do with all of the other salaries that we record for all of our other employees. That actually impacts the partner's capital accounts. And we account for those salaries when we allocate net income. I'm going to show you what we need. Any profits or losses of the partnership have to be divided based on some agreed upon ratio, whether it's 50-50, 60-40, percentage of initial contributions, whatever it is. But let's look at those methods. So there are 3 overall methods that the partners could possibly choose: stated ratios, capital balances, and then a combination of salaries or services, and then capital balances and stated ratios. So we're going to see all 3 of these, and we'll also get to see the entry. The entry is just a regular old closing entry. This is the 3rd closing entry where we close income summary to the capital accounts. You learned that in chapter 4 in accounting 1. If you need a refresher, go back and look at chapter 4 in your textbook. So in the partnership agreement, Zane is to receive 2/3 and Perez gets 1/3 of partnership income or loss. If the partnership income is $60,000, this is the journal entry that we would do to allocate that income. So at this moment, after I close revenues to income summary and expenses to income summary, I now have a $60,000 credit balance sitting in the income summary account. I know it's credit because it's net income. I need to determine what portion of this $60,000 belongs to Zane and what portion belongs to Perez. Well, we're told 2/3 and 1/3. I take 2/3 of the $60,000, and that's the amount that I'm going to give to Zane. And I take 1/3 of the $60,000, and that is the amount that will go to Perez. We debit income summary for the full amount of net income, and we credit each partner's capital account for their share of the partnership income. So when we say stated ratios, it could be 2/3 or 1/3. It could also be 67% and 33%. Now let's look at the next method. The next method is allocation based on capital balances. So typically based on what the partners brought into the business, their beginning capital balances. So from those previous entries that we just did, remember we credited K Zane Capital for $30,000 and Perez brought in $10,000 in cash, so we credited Perez for $10,000. We now find ratios based on their contributions. So we take Zane's balance and Perez's balance and we add them together, and that gives us our total. We then divide each partner's balance by the total to come up with a percentage. So 30,000 divided by 40,000, that's where the 75% came from, or 3/4. And then 10,000 divided by 40,000 gives us the 25%. We then multiply those percentages times the net income to determine each partner's share of net income. Notice that the journal entry is the same. We're still debiting income summary and crediting capital. It's just the numbers are changing. One partnership decided to select the method of stated ratios. This one decided to use an allocation based on beginning capital balances. But we're still boiling it down to a ratio. It's just how we calculate that ratio. Now, here is the fun one. The fun one is a hodgepodge, or it's a mix of capital balances, something to do with our capital balances, stated ratios, as well as service. So let's look at this one in detail, and we'll also see how this allocation can change depending on net income or the balance in the income summary account. So now we have Zane and Perez, and their partnership agreement requires that Zane receives an annual salary allowance of $36,000 and Perez receives an allowance of $24,000. Please keep in mind that these allowances, these salary allowances, are not salary expenses. You cannot be an employee of a business that you own when that business is a sole proprietorship or a partnership. So we have to deal with these salary allowances in the allocation of income. Now, each partner, in addition to their salary allowance, is allowed an annual interest allowance of 10% of their beginning capital balances. So we're going to take 10% of each partner's capital balance, and that's going to help us allocate income. And any remaining balance of income or loss is allocated equally. So net income is $70,000. Now, the easiest way to do this one is to set up this table. In this table, we begin with allocating net income. So net income is 70,000. We have a column for Zane and a column for Perez. After we determine the amount of net income, we're going to put that in our remainder column because the object here is to get this remainder column to 0 so that we can determine what portion of this 70,000 should go to Zane, what portion should go to Perez. So we saw on the previous slide that Zane should receive a salary allowance of 36,000 and Perez should receive a salary allowance of 24,000. Why does Zane get more than Perez? I don't know. Maybe Zane does more work, but that's what the partnership agreement says. You can have the partnership agreement designed so that Zane gets a salary allowance and Perez gets none. Just depends on what those partners decide. So once we give 36,000 to Zane and 24,000 to Perez, we have to determine what portion of net income is left to allocate. And here's what I mean. We started with 70, and I'm saying of this 70, well, during the year, Zane got 36 because he got a salary allowance, and Perez got 24 because Zane is Kayla. She and Perez got a salary allowance of 24. So when we combine those two numbers and subtract them from the net income, we see that we have $10,000 in net income remaining to allocate. So that 36 plus 24 is 60. We subtract that 60 from this 70 to find that we have 10,000 left to allocate. Now, the next item that they're supposed to get is interest. And that interest is supposed to be 10% of their beginning of year capital balances. If you're looking at a problem in the textbook or a problem on a test, you have to be given the beginning capital balances. You can't just guess or figure that out on your own. In the real world, it will be presented for you right there. So the beginning of year capital balances here for Zane, that was 30,000, and Perez was 10,000. We take 10% and we give that to Zane, which means we now have less net income left to allocate. So once we give them that total of 4,000, we subtract that from that 10, and we have remaining 6,000 to allocate. In the last step, we're told that whatever's left over, those partners share in that equally. So we cut the 6,000 in half and we give 3 to Zane and 3 to Perez, leaving us with the remainder of 0. We add up all of our numbers here. Remember, you allocate salaries first, then you do interest, and then whatever's left over, the partners share in equally. Once you add those numbers up, this gives us the amount that we need to credit Zane's capital account for in our journal entry when we close income summary to capital. We do the same thing for Perez, and we add up those 3 numbers, and that gives us our credit figure for our entry. Once we combine those 2 figures, when I add 42 to 28, I better get 70 because that's all I have to allocate. All we're doing is shifting numbers around here and determining which amount should Zane get, which amount should Perez get. So when I add the 42 and the 28, I come up with the 70,000. Now, what if net income was only 50,000 instead of 70,000? Well, the first 2 steps would still look the same. We would still give Zane and Perez their salaries. But when we add those salaries together, that comes to 60,000. We subtract that from the net income that's there to allocate. And look at this, our remainder becomes negative. And I know you're thinking, negative, what are we going to do with that? Don't change it as of yet. Leave it as a negative. Because we have to give them this. It's in the partnership agreement. We also have to give them their interest. So we go further into the hole here. We give Zane her 3, and Perez his 1. Combine those 2, subtract it from the 10,000. 10,000, negative 10,000 minus 4,000 gives me a negative 14,000. Any remainder, whether it's positive or negative, gets allocated equally. So we're going to cut this negative 14,000 in half, and 7,000 will go to Zane, 7,000 will go to Perez, but it's a negative 7,000. So that when we add up all of our figures here, we have to make sure we're not ignoring our signs, and we end up taking the 36 plus the 3 minus the 7. And then the 24 plus the 1 minus the 7. When I add up my two totals here, it better be equal to the amount of net income. If not, we did something wrong. So when using this method, this hodgepodge method here, the partners have to get their salaries. A partnership agreement says it. They have to get their interest, even if it takes you further into the hole, even if you start with a negative. What reconciles this is that the remainder gets allocated equally. Now, if I started off with a negative here, then the income that's allocated to each partner, of course, when I get to my final number, that's going to be negative, and that's okay. That just means I need to debit Zane's capital account and debit Perez's capital account in order to make my entry balance. So in summary, this is a partnership financial statement. Remember that our financial statements are the income statement, the statement of owner's equity, the balance sheet, and the statement of cash flows, which we didn't pay much attention to in accounting 1. The income statement for a sole proprietorship is exactly the same as what we would find for a partnership. But the statement of owner's equity changes because the statement of owner's equity is now known as the statement of partner's equity. And I show this detail of the calculation of the ending capital balances for each partner. Included in that detail is how we allocated net income. So we're still using that same basic formula of beginning capital plus investments plus net income minus withdrawals. But the net income area is expanded because it shows my detail here. We subtract out our withdrawals and we arrive at the ending capital balance. We show this for each partner and in total. The balance sheet changes as well because instead of owner's equity, we have partner's equity, and we have more than one capital account. So I so appreciate your time and attention in watching this video where we cover the definition of a partnership, the characteristics, and we looked at the entries for forming a partnership as well as how to allocate income and losses. Thank you for your time and attention, and I hope you have a wonderful day.